my screen. All right, you should see my screen.
Yep.
So my name is Ivory Becker. I with Alicia Alt, she's my business partner. We co-founded Credit Score Pro AI. We're going to talk a little bit about what Credit Score Pro AI is, AI in general, and then a bit about what's going on in the market today. So we host these webinars every single Thursday. So bi-weekly, they're aimed towards professionals, and then the opposing week is aimed directly towards consumers, so your clients. We founded Credit Score Pro about a year ago after combining efforts in the credit space. Allie's been in the space just over almost 21 years, and I'm almost at 16 years now in the financial services industry with a heavy focus on credit. We know credit is one of the foundations of approvals for lending in general, yet it's one of the most overlooked and misunderstood or just not understood at all topics. So we aim to bridge that gap, not only for consumers, but for professionals as well. So we want to take a look today at market conditions, some of the difficulties that we're facing both on the professional and the consumer side. And then, like I said, learn how AI can bridge that gap. And then ideally, we want to get more clients approved, more clients at that closing table, more clients able to buy homes, get those business loans, whatever they're trying to do. And then show you how those AI-powered solutions can help, and then give you more of an edge when it comes to your competitors. So I know there's only a few of us on the actual Zoom meeting today, but if you're on Zoom, if you're on the Facebook, or if you're on YouTube, feel free to comment in the chat, or you can just unmute yourself if you're here live. I do prefer it to be more of a conversation. It makes it a lot more entertaining, not only for us here, but for anyone watching later. We want it to be applicable for you. So, and I keep saying we because I'm used to having Allie on here, so just overlook that part. So AI. If you turn on TV, we hear all about AI. It's getting pretty crazy to the point now where I see some of those AI generated photos, and some look pretty realistic to where you can't really tell the difference. Really, in every realm of business, we're starting to see the integration of AI in some capacity. It's no different within the credit space. And we're even starting to see a transition into utilizing AI, and I would say more advanced techniques in predicting what consumers are going to do, right? The whole point of a credit score is for risk management, right? How much risk is it for this bank, this lender, to allow that consumer to borrow, right? So by having better systems to analyze that data, banks are going to make even better decisions when it comes to lending. I guess I talked a little bit about this. We're seeing AI used, and actually I'll just go to this side, and a lot of automation for making decisions. So gone are the days where you have to have a human actually physically look through every single document. With some of these automated lending decisions, they're even to the point where they're actually analyzing consumer documents or client documents, making sure that there's no fraud on these documents that are supplied. So essentially, AI is being integrated into every facet of what we do, and banking and lending are no different. And it does also streamline the process and make the process more efficient for both the client and you on the lending side as well. So I don't know, Kelly, have you worked with any, I know you're on the title side of things, have you worked with any lenders that are using some of this automated lending decisions?
Yeah, it's interesting you bring that up. I had lunch yesterday with a residential lender, and he had actually shared that he had just processed his first home equity line of credit with a client that went AI, and they had an actual credit decision within 25 minutes.
That's
So
crazy.
it was insane. So as he was explaining it, I was like, I'm sorry, what? So he was saying that as the program that his company has is that as the client was uploading basically the application,
Mm-hmm.
listing out their information on the backside, the system was pulling their credit, verifying their income, um, calculating their DTI, and
Mm-hmm.
literally, and then as the customer was going, they were also uploading their taxes and so forth. Literally, where within a 25-minute process, start to finish, the customer had an approval and that list of conditions, and the list of conditions were met same day.
Mm-hmm.
Jerry was walking through with his client as it was going. They were ready to go, sent him the documents that he was to collect, reached out to insurance. They were able to actually order loan docs that were printed and ready to go the very next day. So almost within a 24-hour period of time, it was also able to go in somehow and calculate the desktop appraisal. So in this case too, he
Wow.
said now in the case where an
Mm-hmm.
actual physical appraisal would need to be ordered, whether it was loan amount or
Mm-hmm.
maybe the LTV was too close. But it was so fascinating because this particular client didn't have a first mortgage. They had a ton of equity.
Mm-hmm.
The process authorized the desktop evaluation to be done. And literally they got loan docs and signed right at about 24 hours. And then they had their 3-day right of rescission. And by the next week, I think he said Tuesday, yeah, because the 3-day right of rescission had started Tuesday or Wednesday.
Mm-hmm.
The line of credit was in place for the borrower, which, yeah, I've never heard of you know what I mean? Literally like
Yeah.
a 3-ish day process. That was pretty fascinating.
I would say that's the height of efficiency.
Yeah, yeah, yeah,
So,
no doubt.
yeah,
It's crazy.
absolutely. Absolutely. And we're going to explore how it's being implemented on the other side, on the credit side, which can benefit the consumer. So, not that that's not a benefit to the consumer as well. It's a huge benefit both to the client and that loan officer to be able to do things. I mean, that's crazy fast.
Hmm.
And
Most definitely.
yeah, and I know the goal for loan officer, realtor, banker, it's really to one, we got to close more loans and we want to help our clients buy and sell more homes, especially obviously if you're on the real estate and mortgage loan officer side. Um, at the end of the day, we have to make a paycheck too, right? And we want to be able to bridge the gap with those barriers that do exist. And right now, one of the biggest barriers and what's stopping loan closings from happening, if we look at a normal market, we see about 35% of leads actually go from, hey, I'm inquiring, I'm curious, I think I want to get a mortgage because I want to buy a house. Um, Only 35% of those people actually make it to the closing table. So we when we see that in a normal market, it's typically because of credit and debt to income. So about 53% of the decline reasons are credit and debt to income, and they go hand in hand, right? If you have if you have a negative credit impact, let's just say a lower credit score, you typically tend to have higher debt to income ratios, right? You pay more for borrowing. So naturally, you're going to have higher debt to income. The interest rates you're paying are higher. Now, if we look at today, what's going on, we are really seeing more of an affordability crisis. I think a lot of this you've probably heard. Housing costs are higher. First time home buyers are a bit older. Renters are renting for longer. Renters are a bit older. We're also in what's not on this slide right now. If we look at recent data coming in as far as delinquencies, we're seeing more people becoming delinquent on debt, and it's all types of debt that we're seeing that. One of the other things we're starting to see is more consumer debt being utilized, and that's really just credit cards. Consumer debt's credit cards. So we're seeing a trend, a 5-month trend. I think it may have edged into 6 months, but I haven't looked at this most recent month's data yet. Where people are utilizing their credit cards more, carrying the balances longer, and not paying them off. So overall, we're seeing more people keep the balances, not paying the cards down. We're not seeing that, hey, I'm using my full balance on my card, but I'm paying it off every single month, right? We're not seeing that kind of activity. We're to the point where people are affording their day-to-day life on credit cards versus just, oh, I had one big purchase I needed to do. It's how they're getting by, because obviously we've all been very impacted by the environment we're in right now. Everything costs more. And what that does, unfortunately, is it impacts credit. And when we become more and more constricted with utilizing our little bit of income we're making that's not rising with the expenses rising, that means we start to see more delinquencies. And when we start to see more delinquencies, what happens with lenders and banks? They start to tighten their policies, right? Lending becomes tighter. It becomes harder to qualify. So the kind of client we're seeing has a bit higher debt to income ratios, lower credit scores, less savings, and more consumer debt, as opposed to when this data came from, right? This data is from 2020. So this is what we saw for clients in 2020, 2021 timeframe, that 53% being credit history and debt to income issues. And now we're seeing even more pressure on consumers. Why I bring this up is because the people buying homes right now are likely to have some of these issues. And the people who already bought homes, they're at that 2.5%, 3%, 3.5%, excuse me, interest rates, and they're going to stay put if they can, unless they have to relocate for some other reason. And the people who do have some of these credit issues are going to likely be more okay with higher interest rates. Because when we talked about having credit issues, they're already used to paying higher interest rates on things. So it's not as much of a shock. Not that they want to pay more, but it's a pill they've already had to swallow in the past. So they're a bit more open to paying more. So now it's about, okay, so we have these types of individuals who want to buy homes or who want these loans. They're willing, but are they able? And the answer isn't always yes. So we want to be able to bridge that gap. So shifting gears a little bit, talking about the credit side of things. On the professional side, I'm curious, for anyone here, did you get any training on credit or how credit works? I see Amy's shaking her head no. Kelly shaking her head no. I'm going to assume it's the same for the others that are here as well. Feel free, Kelly, were you going to say something?
I was just going to say, really, I mean, and being a banker for a very long time, there wasn't a lot of detail. I mean, but I will say, and fairly consistent across the board with a couple of the different institutions I worked for, was, basically they'd say, hey, the client can't be over 40% utilization. Don't share the credit report. I mean, it literally was just as basic as that. And so we'd be like, huh, okay. But once we'd submit a loan app and we'd see those credit reports, yeah, it's quite overwhelming as to what we're actually looking at. To go into more detail is, what I mean? We can see if they're late or collections, because those are right up front, but not a lot of detail in understanding, why their DTI is so high or how to read it.
Yeah, you get this credit report sitting there in front of you, and you have a client, either over the phone or sitting at their desk in front of you, saying, "Okay, so what's wrong with my credit?" And now you have this big report you're scrolling on. And you're like, "Well, I see a late mark here. That could be the problem," but you don't really know, right? It's what's that general makeup? How does it work? So knowing how to analyze the credit reports and how to understand why the score is what it is can be so helpful. So being able, I would say at a basic level, to just be able to answer those basic questions and feel comfortable with the answers you give is huge. It also sets you apart from your peers, and it makes that client trust you. Even if they can't do a loan right now, it shows that you are a resource. You're somebody who they can rely on. Even if you can't give them the loan now, you can give them the opportunity to have the loan later and the resources they need. So we're going to talk about how to do that. So before we do that, we'll look at the impact of credit knowledge and lack of knowledge. So this is just a case study. We had a client that started at the 514, 518, and 473. By the end of the process of using the software, she was at 741, 681, 714. So huge changes in scores. And just by having some understanding of, okay, well, what's missing from credit that can be added, that can boost scores, and what can be tackled that's adversely pulling scores down, you can see that jump happened in less than 6 months. About 6 months, almost 6 months. It's like a week shy of 6 months. So there's a lot of opportunity for these individuals who you may have looked at and said, you may have looked at before and said, well, you know, this is kind of a lost cause. I don't know if there's any opportunity here. You know, I'll see you in a year or two, go work on your credit. What do? Now what? So giving or being able to provide the resources is going to lead to these outcomes of having these scores. There's a heck of a lot more you can do with those credit scores than you can do with those in the 500s and 400s, right? All of a sudden the world opens up. So we can use AI to get here, right? To get to, from these 5s and 4s to these high 6s, 7s, and hopefully even higher, right? Why would we use AI? I think we all know efficiency, accuracy. AI, true AI, is machine learning. So it's going to continue to analyze and change strategy based on what's worked and what hasn't worked. And Credit Score Pro is a software that we have, and we'll look at it, where what it does is it's an AI-powered credit analysis as well as action plan, dispute software. So it's an all-in-one credit management tool. So the AI itself is going to analyze the report, determine what needs to happen, and then take action. So the nice thing about it is because it's AI, it takes away everything we talked about here. The what you don't know, the things you weren't taught, right? Now the system has all of those answers. And we know 37% of adults have a credit score below 700. So that's a large amount of individuals across the United States. And of course, there's pockets of people that have where you're going to see more people below 700. And what we're actually seeing right now in credit scores is if we look at scoring, credit scores in general, if we look at, there's ranges. You got subprime, you've got near prime, prime credit scores, and then super prime. Super prime, that's like your people that are almost perfect. Prime, that's your sweet spot, right? Those are your people in the 700s. And then near prime are the people in your high 6s to mid 6s, and then your subprimes, everyone else in those lower score ranges. What we're starting to see is this spread away, this driving away of people in the prime. So we're seeing a lot of people going from prime down to near prime, and then the near prime going down to subprime because we're seeing more delinquencies, the higher credit card utilization. And then we're seeing some in the prime go up to super prime, but unfortunately a lot more are going down than up. So while 37% have been below that 700, we may see an increase in that. And the whole point of using the AI is to provide solutions for those 37% of individuals, get more approvals, create more trust, and really expedite everything that you're doing. Give that additional resource that you didn't previously have. And then, of course, having those solutions allows you to, I guess I would say, you have this ongoing pipeline, right? Because let's be real, someone with a credit issue, we're not saying it's an overnight fix. It's not. Like, that's the reality. You don't ruin your credit overnight, you don't fix it overnight. But being able to have a consistent pipeline of people who every month are getting to the point where their credit's ready, you can move forward, the credit's ready, you can move forward. When we saw this big transition between like this gangbusters crazy market where everyone was doing business to this like stop, the people who had that pipeline were able to keep going. You know, it may not be the volume you had before, but you can survive. And that's really what we want to help generate. So we know there's a lack of training on credit and financial services, and you're supposed to be the expert. You're supposed to know all of these 5 factors. So I'll break this down slightly. I want to what I want to highlight in looking at this is the things that you probably didn't know about credit and you wouldn't know to advise your clients. So when we look at, so it's kind of some of the myths or the hidden facts. So when we look at a credit score, this is the general aspects that make up that number that you see, whether it's the 700, the 500, the 400. The credit score is really created for the lender, for the bank. I think that's an important concept. It's not made for you, right? We all have a credit score. Your credit score is not made for you. It's made for a bank, right? It's made for a bank to determine if they want to let you borrow from them. So if we look at payment history, that's 35% of the credit score. I think most everyone here is probably familiar with payment history, right? You pay on time, you're rewarded. But what you may not know is that any of your open and active accounts, if you close them, that payment history no longer helps your score. So it doesn't matter that you had 10 years of loan history on that account. Once that account's closed, this category isn't benefiting from it anymore. So this is only your open and active accounts. So that means that credit card that you use once a year, if it's not active, if you're not using it every 3 months, you're not getting the benefit of that payment history. It has to be an active account. And so amounts owed, that's looking at utilization, what's your balance versus your credit limits. That's only your credit cards. The only time utilization is looking at your loans is if you owe more on your loan than the original loan amount. Does anyone know when you would owe more than your original loan amount? Where do we see that? What kind of loan would you ever see that with? Might make you think hard. You're on mute, Kelly.
Would that be a revolving line of credit that maybe you were issued a certain amount, but maybe you have had some increases?
So if you
Along
go
with-
for a limit on your credit card, yes, that would affect it. But credit cards always affect amounts owed or utilization. So more loan, like an installment account. And I'll give you the answer. The installment account where you see a balance greater than your original amount is student loans. So while you're in school, the interest is accruing, and then once you get out of school and they tack on that interest, you may have had a $10,000 loan that's now $12,000. Now you owe more than that original loan amount. That's the only time a loan actually negatively impacts this category. So why I bring that up is if you have a client who's getting ready to get a mortgage or a loan and they want to pay down debt to help them, paying down a loan is not going to do anything if their loan was originally 10,000 and they owe 7,000. Pay it down to 6,000, pay it down to 2,000, doesn't matter. It doesn't do anything for your score. Instead, you would focus on credit cards, right? And paying those credit cards down. Does that make sense? Cool. So length of credit history, that again is only looking at open and active accounts. So it's really important that we just think of the credit score as it's meant to predict how likely you are to pay on time, what your credit risk is, but it wants good data. It doesn't want old, stale data that doesn't matter, data from 8 years ago. It wants to look at what you're doing now. So there's a lot more when it comes to understanding credit scores. But again, if you can have AI looking at every aspect of this, all the nuances, knowing what accounts, paying what accounts would boost scores up, paying and knowing what accounts would drive scores down, and so much more, it would be so much easier than having every single fact like that. So how can AI help? It will dispel the incorrect common knowledge. I gotta stop clicking. It will dispel the incorrect common knowledge. So some of that common knowledge, we hear keep your credit cards under 30%. No, keep them under 20%. No, make sure you always carry a balance on your credit cards. There are all sorts of things, right? There's a lot of common knowledge out there that isn't necessarily correct. It takes the guesswork out of understanding credit as well, right? You don't have to be an expert if the computer can do it for you. And it removes the requirement for you to give those wrong answers on accident. I don't know how many of you have been in the business and thought you gave the right piece of advice just to find out it backfired on you. Maybe you told someone to pay off an old account and all of a sudden, instead of it raising their score, it lowered their credit score, like a charge off or a collection. And you were like, ooh, I just made that situation worse. And so much more. I won't belabor that anymore. So what is Credit Score Pro? So it's an AI powered tool. I think what I'll do is I'm just going to show it to you. I think that's probably a good way to look at it. It's going to be very different than what a Wayfinder or a simulator tool does. So have any of you used a simulator Wayfinder, seen it before? No? Okay. So a simulator is essentially, you can put in scenarios, like a scenario. What if I have $5,000? Where should I pay that off? What should I do? Unfortunately, sometimes the simulators aren't accurate. They're not correct. We had a scenario where the simulator was telling someone not to pay their full payment on a student loan, and that would help their score. So it was like pay 200 instead of the $250 payment, and your score will improve. And that was the document they were provided by the lender. Do this. Well, if that client did that, all of a sudden they get a 30-day late mark. Doesn't really make sense. Most of the simulator tools are pretty limited in what they can do. One of the main differences is going to be Credit Score Pro can look at what's not on your credit report. How do we not only just optimize the accounts that do exist, but what about where you're not impacting the credit score algorithm? Right? What if you have your credit cards are stale and they're no longer helping improve your score? The simulator tools can't do things like that. So let's take a look at, I'm going to stop sharing my screen and I'm going to go ahead and pull up the AI. Oh, and I missed what Jeff said. There's my stop sharing. We didn't use credit scores when I started, is what Jeff said. Yeah, I think it's interesting too. We're using credit scores more and more and more in every industry. We're seeing credit score requirements on renting, in some cases even higher than what's required in lending or in buying a house. We're seeing credit scores needed to get cell phones plans. I mean, everything. It's getting really, really integrated in our society more and more and more, which is why credit is it's so important to have a solid understanding. Okay, so what I'm going to do is I'm going to show you a little bit about how Credit Score Pro AI works. Let me just get my screen shared here. Okay, so Credit Score Pro, let's do screen number 2. Bear with me while I try to do this. There we go. Credit Score Pro AI, what it does is it connects with our partner Smart Credit so we can gain access to the credit reports. One of the best things about Credit Score Pro is it's free to the consumer. The only thing the consumer pays for is the credit monitoring through Smart Credit. One of the great things about Smart Credit is it does come with built-in identity theft protection insurance. So let's say you had identity theft in the past, even before you sign up for Smart Credit, they will help make sure you're reimbursed for any losses there. And there's a lot more, but we don't need to get into that today. So once a user of Credit Score Pro sets up their credit monitoring, they gain access to use the software. And I'm showing a demo account, so there's going to be a few features that might not fully work because it's not a real human credit report. So the first thing they'll see is their 3 credit scores from the 3 bureaus. And then they'll see how many items on their credit report are positive, negative, and they can look at their full credit report as well, or they can click on each of these items to see what's positive, what's negative. So here I can also click up here to see the credit items. If they click the plus sign, they can see everything that's going on with their credit report. Though we try to make everything very simple. So the more simple it looks, the easier it is for any consumer to take action. So if I wanted, I'm going to start with looking at how the AI works when it comes to negative information on a credit report first, and then we'll look at everything else that it can do. So the first thing it's going to do is if you want to look at just the negative accounts, you can click negative. And you can create disputes that go to the credit bureaus based on AI analyzing the raw data of the credit file. Maybe curious what raw data means. So when you pull a credit report, you get to see whatever that vendor wants to show you. So let's look at this one, for example. We can see the account number, when it was opened, that it's a charge-off account. But on the back end, a credit report that's about 10 pages is about 500 pages of code. So that's a lot of data on the back end. Why it's important to understand that is the AI is looking at all of that raw data and looking for any errors. Errors are important to identify because when it comes to the credit reporting, so Fair Credit Reporting Act, Fair Debt Collections Practices Act, specifically FCRA, Fair Credit Reporting Act, there is a requirement for all information on your credit report to be accurate and to be complete and to not be obsolete or too old. So the AI is looking for those issues on the back end. So you, as an individual with your own credit, you don't have to know whether it's compliant or not. You don't have to be able to look through all that data and find the errors. So let's go ahead and let's create a TransUnion dispute. So what I'm going to do is I'm just going to click on a few accounts. And I'm not going to click on too many because I don't want to leave you here all day. And then once I choose the accounts I'd like to make a dispute to TransUnion on, I'm going to click add dispute reason. And then AI is going to write the dispute down here. Now, you can choose a dispute if you'd like. We don't recommend that. You should let the AI do it. But if it's identity theft, AI is never going to know, right? AI doesn't know if something's identity theft. So you're going to have to indicate that, or your client's going to have to indicate that if that's the case. So apparently I chose identity theft in that one. But we recommend just doing the suggested dispute reasons. And then you just click finish. And that's it. So the client would then go on and do it for each bureau. But literally, AI just does it for them. They just have to click and choose which accounts they want to dispute. So we do make the consumer choose the accounts because, one, we don't know if it's identity theft. There needs to be some ownership on what needs to be disputed. Now, from there, they're automatically going to get an email with the dispute letters where they can print and mail the letters to the credit bureaus, or they can come here and download and print. Or we know not everyone wants to do that, so we've integrated with Mail-IO. So if they click this button right here, Mail- will actually send the disputes to the bureaus for them. So pretty important, very easy, very quick. And then the nice thing is every 40 days, the credit report's automatically going to update. So you see it's reset to 40 days because we just created new disputes today. And then in 40 days, when it imports a new credit report, it's going to analyze down here if anything's been deleted. And when they redo the disputes, it's going to look at the prior dispute. It's going to look at the successes and failures of other disputes for every other user of Credit Score Pro. So it's constantly updating and changing, right? That's what the machine learning is, and determining what's most successful. And then it does automatically import that report and do the comparison of the old report and the new report, looking at that raw data on the back end, seeing what's changed, all of that every single time. Now, outside of the dispute side of things, because that's only part of the puzzle of the credit score, we also have credit coaching that's in here. So we have a full education platform to teach the users, whether it's professionals or consumers, about how credit works. So we have a section that starts with how credit matters, understanding the different types of credit scores between mortgage credit scores, business credit scores, what you see on Credit Karma versus what the banks see, and then breaking down all the score factors, what to do if you don't have a credit score, understanding credit myths, how to rebuild credit after credit damage. So there's a whole section in here that teaches the backgrounds of credit and how it works. And then at the same time, we also have the credit action plan. So let me go ahead and bring that up. And the credit action plan, unfortunately, doesn't have a demo on the back end because it's connected in with FICO. So there isn't a way to demo that without showing you someone's credit report. So I can't do that, but I can show you screenshots. So that's what I'm going to pull up now. So we talked about, wait, I have to click screen share first. That would help. Okay. You're just gonna have to bear with me while I find the right slide. I think this is gonna do it from the beginning, but that's okay. Cover your eyes while I do that so it doesn't hurt. Okay, so the other part is the credit action plan. So this is gonna be where the client is choosing their goal. This matters for a few reasons. One, your goal needs to drive the steps you're taking. Because one, if you're getting a house, debt to income matters quite a bit, right? If you're getting a business loan, I mean, everything impacts the way the plan is built. But most importantly, there's different credit scores used in business lending, right? Than what's used in home lending, etc., right? So by the client picking their goal first, the credit action plan is going to then analyze the credit report and determine, okay, so if we're getting a home, we're going to use classic FICO. If we're doing a business loan, we're going to be looking at FICO 8, right? If our goal is to get out of debt, well, that's a different strategy than if we're trying to buy a house. And then your action plan is created, and the action plan focuses on the top 4 items that are going to be the most impactful. And then as the user completes an item, the next most impactful item is replaced, and it shows them what they've already completed. The nice thing about the action plan is if you look at this individual, if you can see it, I know it's a little small on the screen. This person has really great credit scores, but it still finds opportunity to improve those scores. So this second section where it says activate cards is looking at those stale credit cards I had mentioned. Hey, you haven't used this credit card. You need to use this credit card to make a purchase of this much, so it factors into the credit score. It's also looking at things that are not on the credit report. For example, if someone needs to establish or build credit, it will recommend certain credit building tools that make the most sense. From free things like Experian Boost to small low-cost items. And the nice thing is these are vetted organizations, not some of these fly-by-night, like really shady things you see going on in the credit space. It doesn't do any of the buying other people's trade lines or anything like that. So it's looking at, okay, how do we optimize the good things and get the most points, and how do we fill in the gaps where that client's not affecting the credit score to get them to that end goal of buying the house, etc. And then every month this automatically updates too. So that's how the AI works. And the nice thing about all of this is for any of the professionals that are using this with their clients, they have access to see this action plan. They have access to see what's going on with the disputes. They'll know where their client's at, right? So they're able to track their clients in that pipeline. And as their scores improve, they can start, doing the process of the mortgage application or shopping for the homes or whatever they're working towards. So what questions do you have for me about the AI or anything else?
Okay, I know you said it's free for the consumer. So I'm a realtor and I'm always thinking about that. Like, how can I help my clients with their credit?
Mhm.
And so if I was interested in using this program, would I be the one to purchase it and then it would be free for my client? How does that work?
Oh, good question. So the client pays for the access to the monitoring. So they're going to pay Smart Credit directly for The credit monitoring, that's $39.99. There is no cost to you to partner at all. And then the client, once they'll basically go to creditscoreproai.com. And when they go there, here, I can just show you. Let me get my window up here. Okay, hold on. I got too many windows open. I can't be embarrassed by that. Okay. So when they go to Credit Score Pro, and you can have your own link too, right? Like we can give you a link. So when they go there, they're automatically pulled under you, right? So then everyone that signs up under you, you can see on the back end. And once they click get started, it'll ask them their information. And once they get to this credit report tab, it'll have them set up their credit monitoring. Once they set up credit monitoring, they've got full access to everything there. So they'll do that directly and pay Smart Credit directly. And as long as they have monitoring active, then they have access to all the software. Does that answer your question?
Oh, you said as long as they have the monitoring active, then they can have, okay.
Yep.
So they do have to still pay the $39.99?
Yeah, they would have to pay the $39.99 to use the software, because the software has to have a credit report to pull for the AI to function, right? Otherwise, there's nothing for it to read.
Oh, I see. Okay.
Yeah, so.
Okay. And then my other question was about the dispute. So I was trying to understand that. Okay, so let's say they do a dispute because the AI sees that there is an issue there. And then after 40 days, they come back and look and that dispute was not successful, then it'll suggest another way to do the dispute.
Yeah,
Like,
yes.
clear.
Yeah, so it will look at the raw data again and do a comparison. Did everything stay the same? Did it not? What changes were made? What makes the most sense for a new dispute? So if we're looking at the success rates, it's much more successful than the traditional credit repair methods as far as the removals. We're seeing mortgage lates removed, which is a near impossibility. I've been doing the traditional credit repair model for years. That's a near impossibility on my end. So I mean, we've started utilizing the software on the traditional space with our clients because it sees more. I think that's really the key, because it can find things that we can't see just looking at the report. It tends to be more successful, but it will have that comparison point. And not everything's going to be removed after the first round, right? It won't be. But it's definitely a lot faster. So we see about 4 to 6 months, which typically would take about 6 months to a year before, if you're looking at time frame differences. Yeah.
Okay. And then my last question was, do you offer classes that kind of go more in depth of learning that credit score and what impacts it and all of that? Do you have?
Yeah. So that education piece on the back end, I don't think I have it open anymore. That's okay. The credit education section in tutorials, and then you go to credit coaching. That part, I think there's 40 or 50 classes in there just on credit. So it's meant to start at the very basic level, and then it gets more and more in depth, and they can pick and choose what they want to learn more about. And just when you have access to Credit Score Pro, you get the full access to all the classes. And then these Zooms, so this week is for professionals, next week will be for consumers. So they can always show up to those events every other week too. So, and then whatever we see as the most common topics, we'll just do a webinar on that. But yeah.
Okay. Yeah, because I know I definitely want to learn more. I know when you asked us that question, it's just like most of the time nobody really teaches you the in-depth of it, because a lot of people want to close on a home and it's just like, well, how do I, explain to them about their credit score and why, they probably need to go work on that first. And so, okay.
Yeah, we have a lot of professionals that use Credit Score Pro too for that educational piece. Versus, I mean, they may also use it for their own credit, because some people, like we have some users who are in the higher scores that are in the low 8s, but they want to stay there, or they want to get to that perfect score. And since the they don't need the disputes, right? They're not using that part of the software. They're using the action plan piece of the software. So that way they know, oh, this card's stale, I got to use this card, or oh, I need to add this onto my credit report, or this aged off my credit report, so now we need to do this, right? So yeah, it's kind of for everyone
Okay, okay,
who
thank you.
wants it. So
Quick
Yeah.
question for you, Ivory.
Yeah.
So when you're saying stale credit cards, are those credit cards that say, like say for myself, I paid off a credit card year and a half ago. Of
mhm,
course, I knew better than to close it,
right.
but I'm naughty. So I took it out of my wallet and put it in a safe place, not
Mhm.
in my wallet. And it's probably been 15, 16, 17 months since I've used it. And I'm all thinking, I'm doing good because there's no balance and that credit's available.
Mhm.
Is that a stale card then? And are you
Mhm.
saying that card, since it's been literally well over a year since I've used it, it's really not necessarily good?
It's
And
just
that
not
it's
helping you. It's as
meaning
if
that they're not using that like, oh,
Mhm.
hey, her $10,000 available credit, like they don't even see that I have 10K available because it's been so long? Or
they're
do
just
they?
not factoring it into your score because the data is too old. It's saying, okay, we don't know how she uses this account because she hasn't used it. So how can I take this information and say it's determinant of what she's going to do in the future if she applies for some other loan, right? There's no data at all. So credit score is meant to see how do you use credit responsibly. So
Okay.
I think that's a good way to look at it. So what we tell most people to do if they don't like using credit cards, they have one they don't want to use, throw Netflix on it, or, some subscription you have, and then have the card on auto pay, and then it'll never be stale. It's always active, because you do have to use it once every 3 months, for it to not be stale. I think the
Interesting.
toughest thing is like the retail credit cards. Like I have a credit card for Victoria's Secret. I know that thing's stale. I'm not going there every 3 months and shopping. So,
Maybe you should.
I don't
Like, oh, shoot, I got to go shopping. Got to keep my credit in check.
know. But, it is what it is. And the reality is too, accounts have to close at some point, right? Like you don't get a car loan and expect it's going to be open forever, but being able to have the software help you with figuring out, okay, now what? Now that it's closed, now what? Or
Right.
things like, well, when do I pay it off if I'm getting a mortgage? Do it as part of the closing, right? Having those educational components in the tutorial section to teach people how to do that, or teach the professionals how to do that's really helpful, because we live our lives. We're not keeping accounts open forever and ever and ever, unless ideally it's a credit card.
Right.
So
Got it. Okay.
Oh,
Cool.
what about line of credit if you are
Mhm.
not using it?
So what about a line of credit if you're not using it?
Like in the credit card, if you are not using it,
Mhm.
it will not benefit your score. But what about the line of credit?
It would be the same for a line of credit. If it's like a home equity line of credit, they're kind of in their own category. Anything that's a mortgage is in its own category. To be fair. So I wouldn't look at a home equity line of credit, if that's what you're referencing, the same as like a credit card, because they are not deemed equal in the credit analysis when it's determining your score. But if it is just, let's say, like a revolving line of credit, like a personal line of credit, that would be looked at the exact same way as the credit card.
Okay, thank you.
Yeah. Yeah. Any other questions? Feel free to ask any credit questions. That's really what we're here for. That's really the whole point of these Thursdays, is to get something out of it.
Well, I know I was interested in the software and everything. So how do we get in contact with you?
Yeah, it would have helped if I left that on the screen, but I will put it in the chat. So, you can contact me directly. I'm going to put my email in the chat right there.
Okay.
as long as you remember at mycreditscorepro.com. That's a good way to contact me. And then I can throw in my phone number on there too. So if you call this number, either myself or Allie will answer as well. I know you didn't get to meet Allie today, but if you watch any of our recordings, you'll see her. You'll see her on the next call. But yeah, give us an email, or give me a call there. That rings through to my cell phone because I can't separate from work. You're a realtor, you understand how that is. But also open if you have any recommendations for topics you'd like us to go over that are credit related. We're happy to make a webinar about that too.
Okay.
I just have one question. Is it $39.99 monthly, or is just a one-time charge?
It would be monthly for Smart Credit. Yeah, they do charge $39.99 monthly. So basically each credit report is $39.99. So they pull in a new credit report once per month. And then one of the bureaus is updated daily. I believe it's TransUnion is updated daily. But yeah, so it's technically $39.99 per report. So if it ever like if the payment ever fails for whatever reason, they won't get any new credit reports till they update it again.
Okay, got it. So it's gonna pull the tri-merge, right? Not the soft pull.
It will be all three credit bureaus. It will be an
Okay.
individual report for each bureau, so it won't be merged.
Okay.
And it's not an inquiry at all because it's monitoring. So it's not a hard pull, nothing like that you have to worry about.
Okay.
Yeah.
Hi, Vera, may I ask you, because I am not in the United States, I'm in Canada. How
Mhm.
can I benefit from it?
Unfortunately, it's just based on US credit scores currently. I know Equifax is in Canada too, but it's just the US based credit scores. So if you have a US score, then you'd be able to benefit from it. But right now it's just in the United States as far as our AI, even though I know FICO's what, in 92 countries, I want to say 92, 93 countries.
Can I ask one last question there? Just a reminder as to the purpose of three different scores and the fact that they all vary. You know what I mean? Some are great and some are not so great. What is again that there's three of them, and obviously like some, Bank of America uses TransUnion, but US Bank uses
I'm gonna share my screen.
Equifax, that type of thing.
I'm gonna pull up an image that I think is really, really helpful for this. So bear with me 2 seconds while I get it. Because I have a giant folder full of here it is. Okay, good. Okay, share my screen again. We'll make this large. Okay. Okay, so we have Equifax, Experian, and TransUnion, right? The big three as far as credit bureaus. We have those three bureaus after they were standardized. So historically, we used to have tons of different credit bureaus with all sorts of different credit scores. None of the models were the same, and they created this standardization for a variety of reasons that I won't get into today because we don't have that much time. But when they created the standardization of using the three bureaus, they also created the standardization of scoring. So instead of having all these different types of credit score models, they just used what Fair Isaac Corporation created, or now FICO, the FICO credit score. So the FICO credit score has a whole bunch of versions. So you can think of this like your iPhone generations, right? We have that first iPhone, and then they're like, we got a newer and better model. That's the second generation. And then it keeps on going and going. So what we have now, and you'll see on the screen, is all sorts of generations. So the number 9 is one of the newer. We actually are on the 10 and then 10T now, which aren't even showing on the screen right now. But basically, all of these different models are still used today, right? Lenders can choose to use FICO 8 or use FICO 4 or 6 or 9. The lender gets to choose which one. So when you have a client that has their credit score pulled for a mortgage, That's using FICO Classic. When you have a client that goes to get an auto loan, they're using a different FICO credit score. They're never going to match. They're never going to be the same. And all of the scores are correct. But this is why your clients get so darn confused. And this is part of the reason why the AI asks for the goal. So it knows, oh, we need to make a goal based on FICO 8 or make a goal based on FICO Classic, et cetera, right? So hopefully that I kind of rambled a bit, but hopefully that answers your question in some sense. Now, I guess to compound it a bit more, these are the FICO credit scores. In 2006, we had the creation of the Vantage score. So that's what you see on Credit Karma, right? That's a new credit score that was created by Equifax, Experian, and TransUnion, and it's a whole different scoring system that functions differently. So we do talk about that in some of our other weekly events, but they're weighted differently, right? Like if you, this isn't the prettiest picture, so I apologize. But if you look at payment history, it's 35% versus 40%. If you look at utilization, 30% versus 23%, right? The weightings are different, so they're never going to be the same.
That's
I don't
cool.
think that answered
Nice
your
and
question
confusing.
fully.
That's all
but
good.
This is why the AI is so helpful, because it can break all of this down and figure all of this out without you having to have all the answers. But we are going to be doing, let me see when the event is. Coming up, we are going to be doing an event that's a deep dive into the new score models that are going to be used in mortgage lending, because it is planning on changing in 2025. Let's see. That one is July 25th. So if you are interested in that July 25th, you can register for it on Eventbrite, Facebook. And then I think that's the only one really super focused on that score model. We do go into the models a bit more coming up here on June 27th, where we're looking at 5 tips for lending professionals, 5 credit tips to advise your clients. And then next week is on credit card debt management. So that one is aimed towards consumers, but can also be very helpful, because it's how to manage for you guys, because it's how to manage credit cards with a focus on credit scores versus a focus on paying the least amount of interest or paying debt off the fastest. It's how do I improve my scores while I have credit card debt, right? We're gonna be seeing a lot of that in the next few years. So it may be a good one to attend as well.
Cool. Thank you, Ivory.
Yeah. We are 1 minute till. So if anyone has anything else they'd like to say or ask, I'm all ears.
So
I'm gonna-
Ivory, just
Yeah.
oh, sorry. Just to make sure, so when there's a difference between TransUnion and Equifax, that means that the algorithm that they're using, like FICO, is different version. This is
I guess I
more.
should have clarified. So all 3 bureaus, Equifax, Experian, and TransUnion, they can, like if you apply for a car loan or let me put it this way. If you apply for a loan and that lender is using FICO 8, they're using FICO 8 score for Equifax, FICO 8 score for Experian, FICO 8 score for TransUnion. So they're all using the same score. The reason the scores themselves are different, even though they're all using FICO 8, is just because a creditor may only be reporting to 1 bureau or maybe reporting to 2 bureaus. Not every creditor reports to all 3 bureaus. So you'll never have exactly the same score, or maybe 1 bureau has information before the other bureau, right? It's constantly moving. Information and data is constantly being fed back and forth. So in theory, if every single account had all the exact same information on all 3 bureaus sent to the bureaus at exactly the same time, the scores would be the same for that model. But FICO 5 model versus FICO 8 model will be different because they're a different scoring system. I think
Yes,
is the best way to put it.
thank you.
Hopefully that made sense. I think I might have made it too convoluted. I get so into it and then
No,
go
thank
down
you.
rabbit holes.
No.
Okay, well, I suppose that is it for today. I hope to see you guys next week or any of the following weeks. We're here every Thursday. Amy, you should have my email in the chat. Feel free, you can do, I have your email. I'll email you too. And we
Okay.
can, yeah, I was like, you registered. I have your email. So
Yes, yes.
awesome.
Mhm.
So
All
you
right.
are going to send us the email with the recording and with with the next sessions to register
Yeah.
in?
Yeah, if you go right here, here's where you can register for the next sessions on Facebook, and then I'll put the Eventbrite link in here too. So either of those will work for registering. And you will be on the email list. If you sign up for this one, you'll be on the email list now. We send an email out that just reminds you of the upcoming sessions too.
Okay, wonderful. Thank you.
Yeah, absolutely. Absolutely. Yeah, okay. Well, I'll see you guys next week.
Mhm. Okay, thank you.
Bye.
Thank you. Enjoy your weekend.
You too.